Spring is here, so maybe you'll think of buying some sporting equipment. Maybe you should also buy a stock in the sporting goods field. We'll take a look. If you're watching this program in South Africa and Russia and the Far East, you think, what is Dick's Sporting Goods? I don't even know this company. It's a brand. It's exclusively in the United States. The stock is interesting, and let me tell you why. Dick's is a well-managed, growing company. No, it's not an exciting company. It's not going to double in the next year. What will it do? It will return steady earnings, steady profits to its owners and to its shareholders. Is it a stock that you want to have? It's worth taking a look. Look at the stock here. Trades at about $46 a share. There was a hiccup with earnings in December, and that sent it tumbling down to about in the mid-30s. It's climbed back to 46 off the high of about 55. What does Dick's do? Dick has 645 stores, sporting goods stores. They look like department stores. Inside are golf clubs and camping equipment, a lot of apparel. A lot of the sporting goods world now is selling clothes, Adidas shoes, Nike sneakers, golf shoes, basketball, whatever. What does Dick's do? It tries to kind of sell branded name equipment, and it offers not discount prices, but good prices. Is it a successful merchant in this field? Has about 10% of the market. Is there room to grow? Yes. What are the concerns with Dick's? The concerns are not the PE. The PE is 12, 13 times, so it's a modest premium to own this company. I suppose the risk with Dick's is the competition online, a competition across the marketplace. Walmart, Home Depot, Target can all sell sporting equipment. Dick's is a little bit upmarket compared to some of the big box stores. Second part about Dick's that I think is a risk, but I don't think it means it's not a buy at some level, is their A and B shares. The family of the founder owns 20% of the company, but probably 65% of the voting shares. It's always a red flag to be in a family company where the public shareholder doesn't control the voting shares of the company. That said, Dick's is very successful at driving its bottom line. What's an example? Earnings per share were about $1.57 in 2011. They're over $3 today. What does that mean? It means for you, that management wakes up every day, goes into its office and says, how do we return more earnings, more income, more of our revenue dollars to our shareholders? Always a good sign in a company. So to sum up, $46 a share, a bit expensive, but it's come off its high. 13 times earnings is interesting. The franchise could go to 1,000 stores. Golf is not a growth industry right now, and it's a big part of Dick's business. But overall, Americans like to buy sporting goods, and they like to pay premium prices for good equipment. And I think that's what they'll find at Dick's, and I hope you find both good health and good happiness, whether you buy or sell the stock. That's all the time we have today on the Investment Advisor. I'm your host, Matthew Stevenson, in partnership with Dukascopy TV. Remember, money can take care of you, cannot take care of itself.